Six-figure salaries used to mean early retirement and a vacation home. Today, households bringing in over $100,000 a year are checking their bank balances before buying groceries. This scale illustrates how the math used to work. A single steady income easily balanced the costs of a mortgage, children, and retirement. But now, even two full-time incomes are crushed by exploding costs, breaking the mechanism entirely. The actual standard of living hasn't shifted. People still want a secure home, reliable transportation, and access to a doctor. Those basic expectations are identical to previous generations. They have simply priced themselves out of reach. Landing a well-paying job used to guarantee financial security. Now, a high salary is just the entry fee to a very precarious survival equation. The largest variable destabilizing household budgets is the exact thing meant to provide security: shelter. Over the last few years, the price of buying a home has shot up at a pace that entirely ignores standard salary bumps. A typical 3% annual raise does nothing when the cost of a house jumps by double digits in the same timeframe, and the sticker price is only half the problem. When you factor in elevated mortgage interest rates, the actual monthly payment balloons to a level that forces even high earners to stretch their budgets to the breaking point. Opting out of the housing market doesn't work either. In major urban centers, rent checks now consume a massive, disproportionate share of workers' take-home pay just to keep a roof over their heads. When 50% of every paycheck goes immediately to housing, there is mathematically nothing left over to build wealth or invest for the future. If housing takes half the paycheck, the other half is being aggressively dismantled by the daily cost of staying alive. Groceries cost more, health insurance rises. Auto coverage goes up, and childcare rivals mortgage. This chart compares wage growth against everyday expenses, and the discrepancy is obvious. Corporate wage increases remain incredibly flat, while the curve for unavoidable daily costs bends sharply upward. This creates a deep psychological friction. People get promoted, take on more responsibility at work, and earn a higher gross income, yet they feel significantly poorer at the end of the month. The raw dollar amount on the W-2 might be larger, but the actual buying power of the modern worker has shrunk compared to their parents. So what happens when the absolute minimum cost of living exceeds the money coming in? Looking at this household budget chart, families patch the math with a hidden variable. They build a bridge out of debt to wedge between their income and their expenses. Credit cards transition from convenience tools into lifeline emergency funds. Auto loans stretch to lower the monthly hit, and student debt lingers for decades. That borrowed money comes with a severe penalty. Compounding interest quietly siphons off future earnings, meaning you pay a premium tomorrow just for the privilege of surviving today. Swiping a card keeps the lights on and maintains the appearance of stability, but mathematically, it ensures you remain trapped in this cycle indefinitely. Despite the grim math, there are households actively thriving in this exact same economy. Their advantage lies in understanding a crucial distinction. Income is the money you trade your time and labor to collect. Wealth is the net value of the things you actually own. Trying to achieve financial freedom solely through your labor means you are in a permanent race against inflation. As the cost of everything goes up, your wages will continually lag behind. To insulate yourself, you have to own assets that appreciate alongside those rising costs. When you hold real estate, shares of corporate stock, or diversified investments, the inflation that punishes consumers actually drives up your net worth. We are no longer looking at a simple division of rich and poor. The economy has cleanly split into two distinct groups: those who rely entirely on paychecks and those who own assets. The idea of an American dream is still entirely possible, but the version from 70 years ago, where a factory job guaranteed a picket fence and a pension, is permanently gone. Navigating today's financial landscape requires precision. It demands aggressive control over personal budgets, a high degree of financial literacy, and completely eliminating high-interest consumer debt. You simply cannot outwork a fundamentally broken equation. The only mathematical way forward is to stop focusing purely on how much you earn and start focusing on the assets you accumulate.